Get it.
So, welcome to the call, everybody. That's Lorene Bright-Kreutz. Right, Lorene?
Correct.
There you go. All right, Tom, we're
With a
going.
black eye and a broken wrist.
Why are you doing
Oh
it?
no.
What's up with all that?
Well, I came to Virginia and you people got me drunk or something, and I just fell down in my own house when I got home.
Well, look, I told you MMA was not your bag, but you did it anyway. So, what can I say? Right on.
That's great. Hey everybody, welcome to the Debt-Free Life presentation. We're very honored to have Senior Analyst Scott Forehand with us. Scott is, yes we are, Scott is also an agency owner. We're both direct to George and Janet Matthews in the 1T Matthews Agency. A little background information about Debt-Free Life. It's a brainchild of Symmetry Financial Group. We started it a little bit more than a year ago. In that first year, the plans that our field underwriters put together for their clients when they're executed are going to retire about $755 million in debt, going to save them over $243 million in interest, and most importantly, going to improve their lives in retirement to the tune of over $2 billion. So it's very exciting program. I myself have not only done one on myself, but my son, and I'm working on a couple other people in my family because this is something that's going to change their lives over the long haul. As far as Scott goes, Scott's been here 2 años.
Yeah, I just had my second anniversary, September.
That's what I thought. Okay. He's been here for 2 years. He's an agency owner down there in the Virginia Beach area. The last time I checked in with him, it was over 60 families helped, over 35 million in debt eliminated, and over 100 million in improved retirement savings. So here's a guy who has done this a lot. He's really become a student of the business, and he has a great way of communicating it. So we're very thankful to have him here to share with us, the Debt-Free Life program. And without any further ado, Scott, take her away.
Thank you very much, Tom. Just for the record, my wife and I just recently fully funded in advance our DFL program. So some of the things that we talk about and the importance of fully funding it early on, we were able to experience that now with the effective monthly compounding with one of the companies that we use. So anyway, without further ado, Scott Forehand, thank you very much for that intro, Tom. I'm an agency owner here at Symmetry Financial Group, and we're here today to talk about the Debt-Free Life program. And specifically, this is meant to be an initial introduction. And so for those of you that are just joining us for the first time, welcome. There's a lot of information. We're going to try to take it at a very high level at this point, so we're not going to try to confuse you too much. This is kind of an unusual program that it's been around for a while in different iterations. But a lot of people, when you first are exposed to these programs, you get that this is too good to be true. How can it work? There's got to be something crazy going on here. So anyway, let me go ahead and get started, and we will share my screen. And here we go. All right. So Debt-Free Life. This is a proprietary product and solution that was originally put on the market in May of 2019. This is a proprietary product for Symmetry Financial Group. This is, if you are here, then you are either invited by me, one of our agents, broker underwriters, or maybe you are an agent broker underwriter just trying to get some more time with this program. And whatever the reason why you're here, welcome. At the end of this presentation, if you were invited here by another agent, underwriter, broker, please make sure you follow up with that individual. I'm sure you're going to want to do one of these programs as soon as possible. So make sure you get back with them so they can help you execute one of those applications and move forward. So what is Debt-Free Life? So Debt-Free Life is actually a play on words. It's a plan designed to get you out of debt and really to change the paradigm of being in debt and being on that hamster wheel that we're all on at some point in our lives, and putting that debt to actually to use for us, and using that money, those debts, to our benefit, not only in the short term and elimination of that debt, but also in the long term, in the process of creating a tax exempt retirement income stream that we're all loving to have. So most of the time we ask two standard questions about to determine if this is something that might be useful for you. Are you 100% sure you're gonna have a great retirement? And I don't know anybody that can say that. And if I can show you a way to get out of debt in 9 years or less, including your mortgage without spending more money, is that something you'd be interested in? And of course, the answer to that question is always yes. And because of this is where we are, the average American. We are taught from a very early age that it's okay to take on debt. And as we move through life, we take on more and more debt. When we turn 18, we buy a car. Then we go to college and we take on student loans. And then we get married. And then we buy a house. And then we buy a bigger house. And then we help pay for our college for our children. And we just take on more and more debt. And eventually, in the end, unfortunately, we're resigned to whatever pension we might have, whatever Social Security is going to give to us, if it's even still around when we're able to collect it, and then whatever else we might have been able to save along the way. And the problem is that first sliver of the column is that we don't save enough. 3% of the average dollar that we make is spent for the purpose of saving for the future. That means if you're used to spending 97% of your money on just normal life, how can you expect to live for very long on just 3% when you're no longer making the kind of money you're making now? And the obvious answer is that you can't. So where we look at with debt-free life is we look at where can we make some changes. And the first thing we can do is we can eliminate some of that interest. And we're gonna eliminate the interest that you pay, cut that down significantly. The next thing we can do is we can eliminate some of the taxes that you pay over time in the form of income tax, and even one of the other solutions we have where we're actually leveraging the property taxes we pay on our homes. Lifestyle, that's the money that we use to live on. That's, putting food on the table, paying the power bill, paying the car payment, put gas in the cars, those kinds of things. We're going to want to increase that sector of our spending. And then finally, back up to the top, that savings number, we have to increase that. We have to make that better. And that's what debt-free life is going to do for us. So over the course of an average life of an American, we're going to make a lot of money, about $2 million in our lifetime. That is a lot of money. But as we mentioned earlier, we only have about 3% or $60,000 left over at the end. It's not enough. If you're making $2 million, then the last 10 years of your lifetime, you should be making, of your work life at least, you should be making somewhere between $75,000 and $175,000 a year. And that's how we get to that 200,000 or that 2 million mark. And if you're making that much money, all of a sudden switching to the point where you have some portion of only $60,000 to live on, plus whatever Social Security is going to give you, it's not enough. This isn't the American dream, and there's a better way to do it. And that's what we're going to show you tonight. So when you first start talking to people about debt and the elimination of debt, you might talk to a debt consolidator. You might talk to a credit counselor. You might talk to someone who's going to recommend some of those bullets that you see on the right side of your screen: work harder, spend less, save more money, refinance, consolidate. The problem with those first 5 bullets is that they're all temporary. Consolidating, you haven't really changed your debt. Refinance, you haven't changed it. Saving more, well, in order to save more, you got to make more. Spending less, in order to spend less, you got to make more, really, or you have to change the way your spending habits are. Work harder, that's, there's only so many hours in a day and only so many weekdays and only so many hours in a week. The one thing that we do key on down there is the debt snowball. And I do want to talk about that for just a second. This is true debt snowballing, what we utilize here. This is not debt stacking. So debt stacking is going to use an approach where you look at the highest interest rates of your debts first, and you pay them off in order of interest rate. That is an incorrect way to do this. It is not the most efficient way. And true debt snowballing, which takes into consideration the creation of the debt snowball, the amount of the debt, and the interest rate, is the most efficient way to get out of this stuff. All right. So moving on. Our better way, this goes back to that question of eliminating your debt in 9 years or less. And I want to talk about that for just a second. When you run a number of these illustrations for a number of different clients, you're going to discover that 9 years or less statement is really, it's accurate, but it's not really the true story. And what I'm seeing is the average is maybe 9 years or the end result may be 9 years or less, but what's really happening is we're eliminating our debts in 15 to 27 years early. And that's an even from my perspective, an even more impactful statement about what this program does and how it works. So let's talk about me, pretty much everybody on this call. The average household debt's about $250,000. That's probably a little light with the numbers that I've been seeing recently. It's approaching, for the last probably 6 or 8 programs I've done in the last couple of weeks, that number is actually closer to about $500,000. But the numbers and the way it's split is still that way on the left side. There's still only about 3% going into savings. And the interest that they're paying on these debts over and over again is still about 34%, and we're still paying about 40% in taxes. And that's not all income tax, just so you know. The taxes are everywhere. Property taxes, tax when you go buy your groceries, tax on your gas, taxes are everywhere. So we can't eliminate all of it, but we can minimize it. And then that lifestyle, that's what we're all doing. That's, the money that's left over, maybe we pay our Netflix bill or a Hulu bill, but it's probably not enough money, or people feel like, as I do, it should certainly be more than that. So where we're going to try to get you to is that right side of the screen. We're going to increase the amount you have for your lifestyle by 10%, which actually represents a 43% increase in your lifestyle money. We're going to increase the amount of money you have for savings by a factor of about 500%. That's huge. So that previous illustration where we only had $60,000 at savings, which might generate $2,000 or $5,000 a year income, we're going to bump that up to $300,000 on average, which is going to be significant. And that's only at that $250,000 in debt mark. So one of the things I want to key on here is when I'm running these illustrations and looking at different scenarios with different families, now that I'm seeing it more and more that the average is coming out to around $500,000, then where we were at 3%, which is the previous illustration, and $60,000, it's actually 120 multiplied by 5. So now what these programs are doing is I'm seeing an average of about $600,000 in liquid cash when we're able to start using it for retirement. And that's a much more tenable position than the previous. The other two things we're going to do primarily, and the way we're going to find these monies, are we're going to decrease the amount you pay in taxes by about 25% over the course of your lifetime. And even more importantly, we're going to decrease the amount of interest you're paying from 34% on the left side of your screen down to 22%, which that 22% is going to represent about a 35% decrease in the amount of interest you're paying over time, which is a big number. So how do we do it? We're going to reduce the interest that you pay over time to your lenders. That's a critical piece. Eliminate your debt in 9 years or less. We're going to eliminate your debt 15 to 27 years early. We're going to reduce the amount of tax you pay over time by about 25%. And that's through the course of income tax and being able to use your homeowner's insurance tax and your homeowner's your property owner's taxes and things like that. We're going to improve your cash flow. So previously, we're going to increase your cash flow by about 43%. So thinking about that, if you currently have $1,000 left over at the end of every month that you can do something with, your fund money, if you will, if we could increase that to $1,430 for you, that's a huge change. Should be. For me, it would be a huge change. And last but not least, we're going to allow you to retire with a tax favored income. And it's not just a tax favored income. It's the it's the best possibly tax favored income of all, which is a tax exempt income. So I told you that earlier that these programs and this concept, excuse me, isn't really new. It's been around for a while, and there's been other iterations of this program that have come before us. The problem with all of those programs is that they all had an Achilles heel somewhere. And of the 10 most recently failed types of programs that are out there, and a lot of them are still very common, one of the common reasons why they failed is they didn't plan for the emergency. So if you think of it like this, if you start the program and then all of a sudden, God forbid, you have a heart attack and you can't work anymore and you're unable to fund the program, what happens? You didn't die, but You can't fund the program. So what we do is we build an emergency fund into this program. And that emergency fund represents about 20% of the money that this program has available. It's in an emergency fund situation, which means you can't see it. We don't want you to have easy access to it. So if you want to get to it, you have to try hard. And that's also because we don't want you spending it on things that aren't an emergency. And I say this over and over, that emergency jet ski doesn't exist. That emergency trip to Tahiti doesn't exist. So we're going to create that 20% emergency fund, and we're also going to eliminate the other 9 reasons, most common reasons why these programs before us fail. So when we compare this type of program, which is a tax-free program, to a tax-deferred or even a taxed program, and that's going to be different versions of your Roths and your 401s and your 403s and 457s and things like that. There is no way, if you run the numbers using the same data points of a $10,000 investment, a 28-year run, a 7% average interest, and a 25% tax rate when you take the money out, there is no way that any taxed vehicle will be able to perform at the same level that this one is. Because in every tax-deferred vehicle, like a 401 or like a 457, not only are you growing the nest egg, but you're also growing the tax at the same rate. And when you finally decide to take the money out, that's when you're taxed on it. And that's when the illusion or the lie of a 401k becomes very clear, which is 15 years ago, 20 years ago, they told you that you could take out a 401k and that when you took the money out, you'd be paying less taxes. That's not the case. Obviously, with as much money as our federal government is spending right now, the taxes have to go up. And if they're going to rescue Social Security, the taxes have to go up. So if you think for a minute that you're going to be able to take taxes out of your retirement plans at a lower tax rate than you would have paid on it when you paid into it, you're delusional, or someone lied to you, and I'm sorry about that. So anyway, so this is a true comparison, running the numbers of a 401 Roth 457 versus a tax-free retirement vehicle, which is the type of whole life policy that these programs are built on, which is called a participating whole life. These programs work in 3 phases. The first phase, called the maximization phase, that whole purpose of that phase is to get you out of debt. We're going to do what we can using money that we find that you're spending inefficiently, compounding it, using different strategies to add to it in a more rapid fashion than you would normally, and eventually using that debt snowball technique to help your debts pay off the other debts and get you out of debt quickly. Once you're out of debt, you're going to reach that middle segment, which is called the accumulation phase. And what that phase is, that's where we're building cash value for your retirement as quickly as possible in a most efficient manner. Okay. At that point in the accumulation phase, you will have paid off all your debt. You might be doing other strategies like annuity stacking or other things that you could be doing, or creating additional banks. But ultimately, the goal is to get to that distribution phase. Now, the interesting thing about this program versus a traditional 401k or IRA is that we are not subject to the IRS's whims about when we can take the money out of the program. We don't have to wait until we're 70 or 60 or 62. We don't have to wait until we actually retire. We can take the money out whenever we want to. There is no penalty for taking it out early, because there's no such thing as early. In the same respect, once you get 72, there's no requirement for you to take money out. If you don't need the money, don't. Let it sit in there, let it ride, let it grow, create generational wealth. So those IRS entanglements that are associated with traditional retirement programs, which are based on banking law, do not apply here, because this is specifically built in contract law, which means the IRS does not have governance over this, with one caveat, and we'll talk about that in a minute. Anyway, moving on. So I mentioned that this is not a new thing. This has been around for a long time. There's just a couple people on your screen that have done this before us. Walt Disney, Ray Kroc, Warren Buffett, Doris Christopher. Warren Buffett still does it to this day. It's not, it's a concept. It's a concept called infinite banking. And then when you couple infinite banking with debt snowballing, then you get one heck of a financial tool. And that's what this is all about. This is about leveraging money, spending money more efficiently, turning your debt on its head so that we use your debt to help finance your debt elimination, and ultimately using all of that for retirement and creating a massive retirement for you at the end. So we already talked about some of this stuff. How do you do this? We're going to redirect inefficiently spent dollars. If you've got a credit card that has a minimum payment of $30 a month, and you're actually paying $50 because you want to pay it off quickly, stop. Go talk to your broker underwriter. Talk to them about how to do it. Just pay the minimums. Save that $20. You're going to use it for this program. We're going to grow cash value. Guaranteed. How is that guaranteed? Well, because this is a contract, folks. And the contract says you're going to get a guaranteed growth of at least 4% per year. And that, depending on who you use, that can be compounded monthly or it could be compounded annually. For my book, I go with the monthly compound. We're going to borrow money from the cash value of the policy. We're not taking our money out. We're not taking out principal. Okay. This is kind of along the lines or the concept of having an annuity, but never annuitizing the annuity, right? You want the thing to continue to grow. You're not taking out principal. All right. We're going to pay off your debt in 9 years or less, really 15 to 23 years early or 27 years early. Repay the loans. Okay, so there's different strategies. This is an advanced thing. There's different strategies about how you repay the loan. The system is designed so that any loan you take will automatically be paid off eventually. But there's some strategies about why you might want to pay it off soon. And that's an individual discussion with your situation. And as we pay off our loans in the program, then we call it here freeing up cash flow. But what that really is, that's creating bank loan capacity that we can use over and over and over again to eliminate other debts. And one of the things I want you guys to think about with this program is not static. It's not set in stone. We have a roadmap. We have a plan that will show you the best and fastest and most efficient way to eliminate your debt and create the largest retirement. But that doesn't mean that life isn't going to happen. Things are going to happen. Maybe you need to buy a new car. Maybe you need to put a new roof on your house. Maybe you need to go put a new water softening system in your home. It's okay. All we do is we just roll that new debt into the program. And the actual result of doing stuff like that makes your program actually work more efficiently than it did without that debt. It's convoluted. It's just the way that the system works. And then finally, that last bullet down there, leaving a legacy. This will leave a legacy for your family, certainly at least one generation. But if you work the program correctly and you have enough time to build into it, you can create generational wealth. And I don't mean, doing something nice for your grandkids. I mean, creating something so that your great grandchildren will certainly be very wealthy if you do this right. And it's pretty astounding how well this thing can work. So this is an old slide. This is when we first started the program back last June. And these were some of the first families that we did. And that's their debts. As we're finding these days, the debts are much larger than that. Most families have a much larger debt, especially when you're considering, home prices today, $250,000 and up. Yeah, those numbers are pretty light. And this is the same thing that we did for them. It's just on a much grander scale that we can do these days. So here's the key difference. I'm going to show you. This is how you currently spend money. You work your job, whether it's a 1099 or a W-2, W-4 job, get an hourly rate, whatever, get a salary, doesn't matter. Or even like those of us who are here with Symmetry, we make our money as a 1099. The end result is the same. We make the money and it gets deposited as income into our bank account. And then it sits there. And then our bank makes money with our money that's sitting in their bank over and over and over again. And that's called, they lend your money out every night at the federal funds rate. and they make 1 point, 2 point, 3 points every night with your money. And then eventually you get to spend your dollar. The average dollar that you put into your traditional bank account, your Wells Fargo, Citibank, Bank of America, whoever you bank with, the average dollar gets spent 7 times, gets lent 7 times by that bank, and you don't get anything for it. You might get a, hey, thank you very much, Mr. Forehand. You've got over $2,500 in your account. We're not going to charge you a fee for you to keep your money in our bank this month, right? There's something that's wrong with that, and that's one of the things we're trying to change. So after the bank has used your dollar 7 times and made money with your money and not given you anything for it, it comes time to pay your debt. So you tell the bank, hey, take that money, spend that $1,000, make my car payment for me. And they do it, and your car payment is paid. And in the end, what happened? Your money got spent. Your money's gone. It's gone forever. You're never getting it back. The bank made money with your money while it was sitting in your bank account, and they didn't give you anything for it. But at the end, what's your net change? It's zero. No gain, no loss, because you've paid $1,000 of that debt. Zero. That's the way the most of the public does it these days. There's a better way. And that's the way that we do it here at Symmetry with Debt-Free Life. Nothing changes about the way you make money. You still work your same job. You still make the same amount of money. As a matter of fact, when we structure these DFL programs, we actually, for the most part, assume you're never going to get a raise, which you know is not going to be the case, but we assume you're never going to get a raise. And that's okay. If you do, great. If you don't, that's fine too. You're fine either way. You make the same money. You deposit the same money into your bank account. And here's where things differ. Instead of leaving the money in that bank account for your bank to use over and over and over again, you're actually going to make a premium payment to your life insurance policy. Yes, I said it, life insurance policy. At the end of the day, this whole thing is built on participating whole life, that specific kind of life insurance policy. So you make your premium payment. So you took that $1,000 out of your checking account and made a payment to your carrier for your checking account. I'm using $1,000 just as an example. Don't freak out. It doesn't have to be that way. I just did one 2 days ago for $130 a month, and it works like a charm. Okay. So we pay for our whole life policy, our participating whole life policy. That word participating is particular and specific. What it means is that because you have a participating whole life, you get to participate with the profits of that company. So you become, in essence, a shareholder of that company. And whatever the company makes, you're going to make money in the form of a dividend. In addition, the carriers understand you have lots of places that you could put your money. But in this case, you're putting it into your whole life policy. One of the characteristics of a whole life policy is that it builds cash value, in most cases slowly over time. But what our participating whole life policy does, it grows at a guaranteed 4% interest rate per year, sometimes compounded annually, sometimes compounded monthly. Okay. So if I have my money and leave it in the bank, and let's say I'm super savvy and I decide instead of having all my money sitting in my checking account, I want to leave it in my savings account until I need it. That way, at least I'm getting, 0.25%, maybe 0.5%. 0.25% for those of you with Bank of America is what you're getting on your savings account with Bank of America. Well, simply moving that money up into your whole life policy gets you 16 times the interest rate. Is your money gone? Nope. Is it safe? Absolutely. What's happening? You're getting a compounded 4% interest. Great, right? Well, that's not all. That money, once you spend it up into your life insurance policy, it has another component. About 21% of your payment is going to go pay for that whole life policy. About 11% of your payment is going to go pay for that term life rider. It's not a separate policy. It's still part of that whole life policy. It's just a rider. Earlier, I told you that one of the reasons why one of the things we did was there's some limitations that the IRS has placed on these policies. One of the things I said was you can't have more cash value than you have life insurance. So that is exactly why we put that term life rider on the whole life policy. It's so that we can increase the size of the life insurance, which acts like an umbrella. It acts like an umbrella so that we can grow the cash value underneath without the IRS trying to tax it. Okay. So the last part of this, last thing we do, where 68% is one of the standard structures here, 68% is actually going to buy paid up additions. So what does that mean? So a paid up addition is nothing more than additional life insurance. However, it's paid up, which means once you pay for that life insurance, you don't ever have to pay for it again. You don't have to pay a maintenance fee. You don't have to pay a management fee. It's a permanent asset. It's not like a 401k where you're paying every month to have somebody manage that for you. It's not like a municipal bond where there's a fee that the bond makers take every year to manage that fund. Okay. What this is once you buy it, it's like cash. Okay. So if you buy $1,000 worth of paid up life insurance today, how much is it worth tomorrow? $1,000. How much is it worth a year from now? $1,000. How much is it worth 10 years from now? $1,000. How much did it cost you to maintain that $1,000 worth of wealth, worth of value? Zero. Okay. So when the banks look at investments and potential types of investments, some of the things they look at are what does it cost to manage it? What's the potential growth of it? What's the potential loss of it? Because don't forget, an investment usually has loss potential. And so what we've done here is we have the absolute best possible type of investment because there's 0% chance of loss. If you die, it's worth $1,000. If you live, it's worth $1,000. And oh, by the way, remember that I told you earlier, this gains 4% guaranteed interest rate? Yep. So let's look at that. When we look at what was there before, that little red circle that was sitting over your bank where your bank was making money with your money every day, now we've moved that circle so that it's over our bank. It's in our DFL bank, and we are making money with our money every day. Okay. How much are we making? Well, it's 4%, depending on the company, compounded monthly, compounded annually. It's also making a dividend. All right. So how does the program work? Where does the rubber meet the road with this? And this is where it happens. So now I've been paying up into my program, and I'm going to use $1,000. Not that it's going to be that big. I'm just using $1,000 because it's easy math. Okay. So if I've got 68% of my money being put into paid up additions, I've got 22% going to whole life, a large portion of which, by the way, is building cash, right? Then I've got 68%. So that's $680 a month. Every month, whenever I make my payment, that's going to buy additional paid up additions. I've got more money in the program than that, but that's all I see, $680 a month. So after 2 months, I'm at $1,360. Okay. Let's say I have a $1,000 credit card that I want to pay off. If I stroke a check for that $1,000 out of my Bank of America bank account, that money's gone forever as soon as the lender or that credit card company receives that payment. It's gone. But if I do it a different way, if I do it the debt-free life way, if I take a loan against the $1,300 that I've got in my paid up additions, if I take a $1,000 loan as a carrier loan and deposit that back into my Bank of America checking account, and then I tell Bank of America to take that money and pay my debt, and then the payment gets sent, and my creditor receives it, then that money became their money. Previously, the way you do business right now, your money became their money. But the way we do it, the carrier's money became their money. My money is still sitting here in this bank, earning 4%, growing every month, and permanently, really. Okay? So this is the key concept. If you get anything out of tonight's conversation, this is the key thing I want you to understand. It's that this is not magic. It really is just math. And the whole goal here is to get you to spend money more efficiently in a different way, a different concept than you've thought about, that you've experienced in the past. So let's look at an example. So this is a family that I worked on last October. These people love this family, great folks. And they've got a lot of debt. And a lot of it is student loans, which the way that they've got it structured, they're going to be paying that student loan for 40 years. They're going to be in their 70s before they're debt free on their current situation. They thought they owed about $584,000. The reality is they owed about $770,000. And that's because of the interest that they have, which is $182,000 in interest over time. Our program got them out of debt in 7.8 years. So we eliminated all of their debts 32.2 years faster than they would have on their own. And that's great. If you just did this as a debt elimination tool, it's awesome. Okay. But this is way more than that. So we eliminated all their debts in 7.8 years. We also created $4.8 million in liquidity. So at the 40-year mark where they were 76 years old, they're going to have $4.8 million. Do they need to wait until then? No, they can take the money earlier. In addition, there's a huge death benefit that this thing's going to have, and we'll show that to you in just a second. But we saved $70,000 in interest. That went right into their pocket. Actually, that went right into the program to be used and grow over time. Here's how their program worked. Their debts were eliminated. Each one of those yellow bars that you see on your screen, that's a year in which they paid off at least one debt. Okay. But where we were before, you can see here in the first year, we're paying off 1, 2, 3, 4, 5, 6, 7, 8 debts in the first year. So at the end of the first year, we paid $14,900 in debts off, and we still have $12,000 sitting in the account as liquid cash. Next year, we paid off an additional $15,000, and now we have over $40,000 sitting in the account. And the next year, we paid off an additional $58,000, and we still have almost $30,000 sitting in the account. And the next year, that year 4, what happened here was there wasn't enough money to pay off any one of their debts in one shot. So all we did was grow value that year, and we grew up to $98,000. In year 5, they paid off a major debt that was $96,000. And by the end of the year, they were back up to $61,000 in their bank. In year 6, they paid off another major debt, which actually was a house. And then now they're up to $45,000 still. And the next year, there's not enough to pay off their last house. So they just built cash value, $123,000. And then the next year, they paid that house off in year 7.8, which means the 8th month of the 7th year, they're paying off all their debt. So that's how the program works. It's a combination of how much money you start with, which is minor, really. But the more important part is how much do you snowball? Okay, so if you've got $500,000 in debt, that's not the only answer to the question. It's how many debts do you have? The more debts you have, plural, the better the program works. The amount of debt you owe is irrelevant. It's relevant to you right now, really, but the amount is irrelevant because the snowball the snowball beats up pretty much any kind of debt you're going to run into, whether it's 200,000, 500,000, or 5 million. It doesn't matter. The snowball is going to destroy that debt, especially when you look at some of the other techniques we're going to talk about in just a second. So in this scenario, what I want you to look at here is this gentleman that we wrote this on wanted to retire at age 75. Okay. But I said, well, wait a minute. You can retire at age 55. So at age 55, he will have $1.5 million in his program. That's liquid cash, folks. In addition to $1.5 million, he'll have $2.7 million in life insurance. At that point, if he wanted to, because one thing I want you to understand, these programs are not set in stone. You can stop and start them when you want to, okay? But if you decide that you want to stop and not pay into the program anymore, go for it. Stop. It's okay. And what will happen is this. So in this gentleman's case, 1.5 million. So $1.5 million, if you put it into a safe fund that's going to generate 5% return per year, is going to generate about $75,000 a year in tax-free income. So if he took the money and put it into a fund, he would create a $75,000 a year tax-free income for himself. What if he doesn't do that? What if he keeps going? So in this scenario right here, he put in $21,000 that year, at year 50, when he's 56 years old. So that means 648 minus 21,000 is 627. 627 minus 512 is $115,000. So taking the money out and putting it into a program that grows $75,000 a year is not bad. I'd rather leave it in here and let it grow $115,000 a year. So when you start reading these ledgers, you start to see some consistent growth things that you want to point out. And that's just something that I observed last week that I wanted to put out because I don't think I've pointed that out before. All right. So what happens if you have someone who's like a student? They don't have any home. Well, in this 23-year-old's case, she doesn't own a home, but she's got a lot of debt. She's got a lot of student loans. She's got over $91,000, over $85,000 in debt at 23 years old. And that's because, yes, student loans, they are evil. So in this case, her $85,000, after you look at the interest she's going to pay, is actually $177,000. She's going to pay more interest than she's going to pay in principal. You guys get that? That's because she's got student loans. They're evil, evil, evil. So for her, she was going to be in debt 40 years of that student loan. So we got her out of debt 30.3 years sooner than where she was going to be, 9.7 years. More importantly, created $600,000 of wealth for her. In her current scenario, she's going to keep paying those debts. And assuming, just like we're assuming here, assuming she never gets a raise, she never graduates from college, all she ever does is work as a waitress, which is what she's doing right now. Nothing wrong with waitresses, by the way. Okay. If that's all she does, then she'll be debt free in 40 years and have zero to show for it. In this scenario, she's debt free in less than 40 years, 9.7. And in 40 years, she'll have $603,000, not to mention a $400,000 life insurance policy that's paid up. Okay. So where we did for hers, we said she wants to retire at 65. I retired her at 55. So at 55 years old, if she wants to, she can stop the program. The program will be on autopilot. It will be growing a death benefit of about $6,000 a year every year after that. It will also be growing a cash value of about $22,000 a year, which she can take as tax-free income for the rest of her life. Can you live on $22,000 at age 65? I don't know. I don't know if she's going to be able to at that time either. But what I do know is this program assumes she never overfunds it. She never puts her tax return up into it, and she never gets a raise. So for her, she could double or triple the payments that she wants to make to this thing, and she'll have double or triple the amount of money down here. So she can take this little $350 a month program, turn it into a $1,000 a month program, and she'll be set for life. Could she do that with a 401? Yep. Would she have this result? Nope. Why? Because as a 401 goes up, it's also going to come down. And anytime you lose money in a 401k, you have to earn back 10% more than your loss just to break even. So, and also you never, with 401s or 403s or any of those retirement vehicles, you never really establish the gain or loss until you take the money. With this vehicle, we capture the gain every year automatically. That should be a critical conversation piece if you're thinking about this as a retirement vehicle. All right. So that's the end of the basic presentation. If you, hopefully you got something out of this, I would get back with whoever invited you and see if they've got some guidance for you. And if you need any help and you don't have anybody that you're working with, reach out to anybody in Symmetry. Pretty much everybody knows how to do this. Okay. So I'm going to stop for a second and I'm going to depart from our normal process because we've got a big training event coming up here at 7 o'clock. And I'm going to, instead of going into some of the advanced strategies that we usually do, I'm just going to go open it up for questions, and we might close this one out a little bit early tonight. So, Tom, I know you're typically, well, now you're in your Hawaiian shirt, which means you're probably not there. There you are. All right. So, Tom, if you've usually got some pretty good questions about some of this stuff, and you too, Barbara. So if you guys have any questions or anybody wants to pipe up, Pat, I see you unmuted. Pat, do you have a question?
I had two questions, Scott.
Okay.
It's the guaranteed amount. Then there's the part that can grow beyond that because
Right.
you're invested in the company. What does that usually average?
The
I mean,
growth?
it's not guaranteed.
Yeah.
The growth.
Yeah. So the only, so I learned early on that I've seen some of the numbers and where they can grow to, but I don't want to quote them because I'm uncomfortable because I don't know, even not, all politics aside, things are going to change and they're going to be pretty rocky here fairly soon. And I don't want to make
Right.
any guesses. So all I can say is the
Okay.
guaranteed return is 4%. I can say historically, these programs practice what's called positive
Right.
arbitrage. And what I'm seeing there is when you run the numbers over the last 20 years, you'll see a positive gain even against the loaned amount 17 out of 20 years. So 17 out of 20 years, you're going to see a growth, and 3 out of 20 years.
Yeah, that makes sense. Okay.
That's when you
Well, I agree
compound
with
the
that.
guaranteed interest plus the dividend on top.
Okay. And the other question was really more advanced stuff. Annuity stacking, but I guess save that for another time unless you mentioned that as a possibility.
I'll go into, we've got some time here. So all
Okay.
annuity stacking is if you use a mortgage chunking campaign as part of your DFL strategy, which will make your DFL program execute 11 to 12% faster than as illustrated. That's what mortgage chunking does for you. Once you get used to or accustomed to doing the mortgage chunk, when the mortgage is gone, what do? So you can let the thing ride, just grow and grow and grow, or you can create yet another retirement income stream, which is what's called an annuity stack. And all that means is that you're taking a solid number, whatever the number is, at least $10,000, and you're buying an annuity. And you're buying the annuities one after the other, just like you would do mortgage chunking. But you're having the annuities staggered by quarter. Okay. So, and this is, if you want to do it the best way is you do it over a 3-year period where every quarter you're buying some number, whatever you're going to have over the course of a year, divide that by 4. That's how much you buy. Okay. So let's say you've got $50,000 that you're going to be you would normally be chunking on your mortgage this year. Okay. So every quarter you're going to take a $12,500 loan, and every quarter you're going to take that loan and you're going to go buy an annuity. Okay. So your first quarter in January, you're going to buy an annuity. Your second quarter, January, February, March, April, you're going to buy an annuity. And that's what you do the first year. You buy an annuity in the first month of each quarter. And then in year 2, you buy the same size annuity in the second month of each quarter. And then in year 3, you do it again. You buy the same size annuity in the third month of each quarter. And what you've just done is you've created a series of annuities that are going to mature after 10 years, 12 years, 15, however long you made it. They're going to be maturing every month. So you've just created another retirement income stream for yourself. So you take the annual.
Got it.
Yep. So that's an annuity stack.
Got it. Thank you.
Okay. Yep. All right.
Here for the nuggets. Thanks, Scott.
You're welcome, man. All right, Lisa, I see you're unmuted. Do you have a question?
Yeah, I do, Scott. So you said about the student that she could turn around and overfund her bank. So in
Right.
other words, if say I sign somebody up and they're going to be paying $500 a month, just for even numbers, at some point they can actually contribute more than that 500 if they wanted to.
Right. And so this is where when you're, and I'm going to talk about this on the next class, the trading class after this. This is where when you're structuring the DFL, you have to be cognizant of where they're going to be financially, and not just next week or next month, but also 2 years from now and 4 years from now. So you have to be looking at that debt snowball. Okay, so all of a sudden my debt snowball, because I've got 6 credit cards that are $30 each, I'm going to be needing to put $180 more per month into my DFL campaign. So I need to make sure that I build enough ceiling that I can throw that cash in there, right? So for her, for example, I structured her so that she could actually triple her payment. She's paying $350 a month, but I structured it so that she could put in an additional $700 a month if she wanted to, and she will, because she's still operating under the old, I'm going to claim zero and get that big chunk of change back from the federal government in April. And that's my little savings account. And no. Okay. She's still doing it though. So at least we have an agreement that she's going to take that $4,000 that she's going to get back, and she's going to immediately chunk it up into her DFL campaign. And then if she wants to go crazy and go, to Fort Lauderdale for whatever, she can put it up there, let it sit for 3 days, pull it right back out, head south, right? So that's up to her. But the whole idea is that we want to be able to capture as much of the program as possible. And that's why it's critical when you're structuring these to look at all the debts, look at where it's all going to be. Because in 3 or 4 years, when you've got that debt snowball rolling, and now all of a sudden you're paying off that $20,000, that $30,000 car that were $400 and $500 a month, now you're adding $900 a month into your program, where you've already added in $1,500. So is your plan going to be able to hold $3,500 a month? And I don't know, because it depends on where you start, but you have a way to manipulate by increasing the size of that term rider, how much extra bank you can put into it. Does that help you?
Yes, it does. And I guess my other question is if you didn't set it up that way, can you backtrack, or can you?
You got 30 days.
30 days.
30
Okay.
days from when it issues.
Okay.
Yep.
Good to know. Okay.
So if it was a small bank in the beginning, there's nothing that says you can't do another bank. Okay.
Right.
The only difference is going to be, hopefully their health has gotten worse, because that makes the bank work better. Okay. The poorer the person's health, the more bank you can have. Works inversely. It's crazy.
As long as they get approved though, right?
Yeah, right. So you have to be able at least to be at a table 4 or better.
Okay.
So table 4 is the sweet spot.
Okay.
Okay. So you can always start a second bank, or as in the case, I just did one of these on a family member. We started a bank on one of the children, at least 18 years old. Okay. So yeah, so you can do multiples. All right. I don't see any other unmuted people. Oh, Laureen Breitkreutz.
You like saying that name, don't you?
Right.
I like pronouncing it correctly.
Right.
Okay.
Way to go. We got 2 people on here that can, 3 people now that can say it.
Right on.
An old group here.
Oh, and it was very nice seeing you in Hopewell. I know you flew all the way out here for that event. So thank you for attending it. Hopefully you got something out of it. We are doing another one in January. It's going to be even better than that one. So start making your plans.
Okay. So you said something about if the health was poor, that it makes it work better?
Yes. Yeah, because the way the IRS rule is written to determine the maximum amount of money you can fund these things, it uses a cost of insurance analysis. So if I'm at $5 per $1,000 of insurance, or I'm at $50 per $1,000 of insurance, this one, the cost of insurance is much higher. Okay. So it's not based on the amount of coverage. It's based on the cost. Okay. So this $5 insurance, $5 per $1,000 insurance policy, it might give me a bank capacity of $10,000 and an insurance amount of $500,000. Okay. Spending exactly the same amount of money with the same 68-32 split when you structure it, but someone who's a table 4 where it's $50 per $1,000. So now I'm only going to have $50,000 of insurance. Okay. But it's the cost of insurance that I have, which dictates the size of the bank. So where my bank before, and this is an actual client of mine, my bank before was $10,000. But since I dropped 4 tables from standard to table 4, the bank got increased 500%. Nothing changed with the premium. The premium's the same. Okay. It's still a 68-32 split, but the bank capacity was raised to $50,000. So that's when I had that aha moment. Now I'm looking at everybody. Okay. You got a family here. How's your health? Good. Okay. Fantastic. How's your health? Not so good. Perfect. We're using you. Okay. as long as you're not doing it for the death benefit. If you're doing it for the death benefit, if that's part of the equation, which in some cases it is, okay? Like sometimes you're going to use replacement of life insurance as a funding strategy. Okay, so in that case, you got to be careful. You know, I'm not going to replace a $200,000 policy with a $50,000 policy. That's not right, and that's a great way to get sued. Okay. All right. Anybody else? Come on, Kat or Sano. I know you got a question.
Aiming it for the second session, my man.
All right, brother.
Hey, Scott,
Yes.
what if you're using it not for just, you know, the debt elimination, but also for an early retirement? The worse the health, the better still?
Yep. As long as the death benefit is not important, okay, then use whoever's in poorer health.
Okay, thank you.
Yep. Oh, and be prepared to fight with the underwriters. So I had one that was in poor health. That's why I wrote it on her, and she was declined. And I said, nope, she's not a decline. She should be a table 3 or table 4. And then we went round and round, and then she resubmitted it, and then she came back as a table 2. So unfortunately, I didn't get my table 4, but she's got the policy now. All right, I see something in the chat window. Uh-oh. Okay, nothing important. All right, so folks, it's 6:31. This is the fastest one of these that we've done. Unless anybody has any other questions, I'm going to go get ready for the 7 o'clock. And I wish all of you the best of luck. Again, if you're here and you're looking at debt-free life for yourself, make sure you get up with whoever referred you to this. They can definitely help you. All right. All right, folks, have a great night. And for those of you that I'll see you at 7 o'clock, I'll see you at 7 o'clock.
Thanks, Scott.
Bye, everybody.
Thank you, Scott. Appreciate it very much.